big moment is finally here. The FOMC meeting is this Wednesday, where Jerome Powell will face all of us and tell us his plans for interest rate hikes right now and going forward for the rest of 2023. But it's not the only big news that's transpiring right now in the economy. There's some other major news that people are overlooking that could absolutely impact everything. So we need everybody to tune in, because we're going to give you the rundown on what you need to know to make sure they are acting properly for this event. So Newski, let's get into it, my boy.
Yeah, so everything we share will be in the description below. And we just want to welcome you to another episode, which is sponsored by absolutely nobody. But so if you do want to sponsor us, just let us know, man. Just comment below. All right. We're two handsome people. That's all it is. But let's get started, right? So the first thing, as Rel said, it is a big week. So we want to kick it off by just showing you guys what's coming up. So we have this right here, which is very, very big, which is the ISM manufacturing, which is straight off the bat. So at the time of this recording, it hasn't happened yet, but the time you're watching this, you already know what the ISM manufacturing report is and what it's going to actually predict for the economy going forward. And then we have what we just talked about, May 3rd. Here it is. Jerome Powell will be talking, letting us know exactly what's coming up. He's going to be going over the Federal Reserve interest rate statement. And then on top of that, we have ISM services, which is very different from manufacturing, but it tells you what the economy is basically doing. And then we have the U.S. job report coming out as well. So there's a lot going on this week. We want to make sure we cover a lot of this for you so you guys stay on top of your game. But well, let's just first start with the ISM manufacturing index, right? So I know we spoke about this earlier, but this right here is basically the overall summary that you guys need to understand. So you want to just read this for them and let them know what's going on, bro?
Yeah, so ISM manufacturing. So like I said, it's a leading economic indicator for the level of economic activity in the manufacturing sector. So if you get a reading that's above 50, that shows that the economy is expanding. That's a good thing. That's great. When you get below 50, that shows contraction, that shows a slowdown in the economy, which is what Jerome Powell is ultimately trying to do, which is slow down the economy. So we want to actually see this below 50. Well, Jerome Powell would like to see that because inflation has been running super high. And so if, like we said, ISM lately has been below 50 for manufacturing, but we're about to look at it, what it is for services, because for services, as you guys may know, service inflation has been running hot for quite some time. And Jerome Powell has been trying his hardest to slow that down. But services is still booming higher than manufacturing has slowed down, though.
Yep. And I know this might sound confusing, because when we first were learning about it and reading about this and having those discussions, it was like, don't you want these numbers to be well, right? Don't you want the economy to do well? Not necessarily, because since the economy has been doing so well, inflation has been going absolutely crazy. Now we want the reverse to happen. So it might sound confusing, but Jerome Powell is actually saying he wants a slowdown to occur, which is why we want these numbers lower. So now that we just went over the manufacturing side, let's just cover really quick the services side, right? So the ISM services survey is a part of the whole institution that comes out with these actual numbers, right? So the service report measures business activities for the overall economy. The same thing, above 50 indicates growth, while below 50 indicates contraction. When you come down here, these are all the different sectors that the service industry is a part of. So you see agriculture, you see education, entertainment, you see healthcare, you see real estate, you see transportation, wholesale, utilities. All this is very important. And the actual number here for March is right here. The services PMI was at 51.2%. And then when we come down, this chart is essentially breaking down for you guys what the numbers were in February. So the services in February was 55.1. In March, it was 51.2. This is for services. So yes, we did slow down. That's why it says 3.9. The manufacturing side, we also saw a little bit of a slowdown, which was 47.7. Then we come to 46.3. So, Rel, we are heading in the right direction, but you see there's still work to do, correct?
Yeah, it's still what you do, because services is still above 50 at the end of the day. So like we said, manufacturing has come down below 50. It is showing contraction. That's great. Services, we in the right direction, but it's more work to do. And that's something that Jerome Powell is probably going to address on Wednesday, as he's most likely going to increase interest rates again. That's what's projected right now.
And I love that you said that, bro, because let's get right into it, right? So what right here is the Fed watch tool. So we went over this multiple times. I'm not going to go into too much detail about it, but let's just look at the numbers. So May 3rd, Rel, you want to just explain to them what this chart really looks like and what this basically is indicating what's going to happen in that meeting?
Yeah, so in that meeting, it's showing that there's an 84% chance that Jerome Powell is going to increase interest rates by 25 basis points. In other words, 0.25% on interest rates hikes. So all this is showing is that every day this thing updates is basically showing that futures traders are predicting what is going to happen at each FOMC meeting. So for the May meeting, this is their prediction on what's going to happen. The 84% are predicting a 0.25% increase.
Yeah, and guys, I know beforehand, right? So when you think about it, I think it was, correct me if I'm wrong here, bro, I think it was June that people were saying that the rates are going to start decreasing, correct?
Yeah, even at a point, they even thought it was going to decrease in May, you know?
And clearly that's not the case right now.
Yeah, nah.
So when you look at it, I was actually looking into it even more. So in June, it says that they're going to most likely stay stagnant. So like if you do see a 0.25% increase for this meeting, which is May, it says in June, we're most likely going to stay around that time. So we're going to stay stagnant. And yes, there's numbers that might, we might see increase right now. I don't know, but right now it says stagnant.
Yeah, it's a pause. In other words, we're expecting the Fed to pause in June. That's what's expected.
And then, bro, I went all the way to even July. So when I clicked on that, it basically told me the same thing, right? It says right now there's more than 50% chance that we're going to stay paused with the interest rate. I went to September, and that's finally when I was like, yo, what's actually going on? That's when there's more of a uncertainty. Like, are we actually going to see a decrease? Or are we going to stay a pause? So now we went from June, even May, to now September, which doesn't really cause like peace in my mind, right? Like, I'm still concerned because I'm like, yo, which direction, like where are we really headed? Because when we don't know what's going on, that's where uncertainty kicks in. And right now we're moving around the goalposts too much for me to feel at a point where I'm like, okay, things are under control.
I'm not gonna lie though, this is speaking to me a lot though, because so we see in September that the market is projecting that the Fed is gonna have to cut in September. Why would the Fed cut? Well, the Fed is only gonna be cutting rates if something is breaking. The Fed is only cutting rates if we're entering a severe type of recession, most likely, or just recession in general. That's when they're gonna have to cut rates to stimulate the economy again. So what that's telling me is that the market is projecting that we're going to have a rough summer. The market is projecting that there's going to be a recession that's really going to onset in the summer time period. That way, when September comes around, Powell may have to start cutting rates. If not September, then November, right? I'm sure November is going to show people showing like more people seeing that we're going to cut in November, right? As you can see right there. So you see that even the majority shows that there's going to be a cut in September. In November, excuse me. So all that's showing, guys, is that if there is a recession this summer, you should be kind of worried as a stock market investor for the summer time period, because typically in recessions, the market does go down. Typically in recessions, the market actually bottoms. Now, it's kind of tough because the market has been rallying lately, right? We're now about to enter May. The market is rallying. Big tech is rallying. You see Microsoft near their all-time highs right now. Like, it's what is going on? So it's
I think they just hit it too. That's the crazy part.
Yeah, and that's crazy, bro. Like, so it's like, what are we gonna get Microsoft and these companies to come back to October lows again? Like, really? And I don't know. I mean, I know we're going to get into that. It's tough to say, and that's why we say never try to time the market. But if we're going off of history, if we are going to enter a recession in the summer time period, then listen, those stocks should ideally come down.
They should, and that's what we have to figure out, right? And I love what you just said, because it kind of points right to the next couple of articles. So it says U.S. economic growth slows sharply as interest rate hikes kick in, because we're seeing interest rates go up, right? We're going to see what's going to happen. It says annual pace decelerates to just 1.1 as fears of a recession this year grow. So you're kind of speaking about it, that most likely everyone is kind of getting to that point of recession, but then we're still seeing the market go up. So it doesn't really make much sense. But what does matter, and this is where we need you guys to really pay attention. So if you're still watching, just give us a quick like, because we're about to show you how this could directly impact you and how you could actually make some money. So when
Say that really quick. You can slow down a little bit.
Yeah.
I'll show something right there. So as y'all see, GDP is what Newski was talking about, where we saw only 1.1%. GDP was expected to be a 2% increase, but we only increased by 1.1%. That's basically half of the growth that we were expecting. So the economy is slowing at a faster pace than we thought. But one thing that the stock market likes is, as you see in that sentence, businesses reduced inventories amid a decline in housing investment. So these businesses are actually reducing their inventory. So the only good thing to take from that, and why the stock market probably went up that day, because it did go up that day, is the fact that they noticed that, yes, we're slowing down as an economy, but businesses are not holding on to inventory, because that's when it's bad. You have a lot of inventory, you can't sell it. Businesses are not holding on to inventory. So they were expecting an economic contraction, and so they prepared for it adequately, and the stock market likes that. This is, in my opinion, the most predictable recession or economic slowdown, and it seems as if the market has priced everything in, and these businesses have priced everything in, and that's why the market may continue to rally. But that's just a theory right now.
And I mean, we're definitely about to talk about that, but real quick, so when you think about it, right, the business part aside, all these big companies, like tech companies, were basically saying how their estimations for the next couple of quarters are good. They're expecting things to happen. I think besides Google was the only one that kind of like held back a little bit. But the reason for this is really because it sounds really bad to say, but when times get hard, what these companies are already going to do and have been doing is just do layoffs. And that's what's going to bring up the whole jobs and the whole report where it's like people are jobless. And that's what Jerome Powell wants. So that's another reason why companies most likely will do well, because they're just going to cut the fat. But the reason why this is going to make a lot of sense for you guys, right? So that's why what a Fed rate hike could mean for your deposit accounts. And we spoke about this earlier. So when the Fed increases interest rates, that means the banks are going to give you more money back on your savings account. So that's where this really comes in. So it says the Fed has already raised the federal funds rate from 0 to 4.75%, which is why you guys have been seeing your high yield savings account and your CD, certificate of deposits, giving you a better return on your money. So when this happens again, most likely when the Fed increases their rates, which most likely they will, you're going to see your high yield savings account and your high yield, actually just CDs even, give you back a more like just better rate in general. So it's a great time for you guys to take that money and put it into your high yield savings account if you haven't already done so. Which speaks to this point, which is why most Americans are going all in on cash, and that could spell more trouble because now they have more money to spend. So it's like a continuous cycle of, damn, are we really screwed right now? That's the end line that we're getting at.
Yeah, and something else to watch out for on that topic of the banks is, y'all seen First Republic Bank is basically going under as they can't hold up right now, and there's a lot of pressure. There's a whole lot of pressure going on with those regional banks, which is something that is kind of brewing. It's showing signs to really like hurt our economy. I'm not gonna lie, because we know the regional banks fuel majority of the businesses in the country, a high majority of the businesses. So if these regional banks continue to go under like this, that's not good. That could really send us into a deep recession. So we have to keep our eye on these regional banks, and even to speak on these small businesses. So I want to show something, right? So people, y'all know we like to bring up charts sometimes, and just as a quick reminder, remember this is all direction of price. So if you see a line going down, that means price is going down. If you see a line going up, that means price is going up. Down again, up again, down again, up again, right? And so this right here is the price chart basically of the S&P 500, which is, you know, the top 500 stocks in the country. You can pretty much say it like that, weighted by market cap. All right, now understand this. You see the S&P 500 from those October lows, which is all the way down here when we bottomed out in October. You see that we've been making a steady trajectory up, right? We never move straight up, but we always move up and down. But at the end of the day, higher highs and higher lows. Exactly, higher highs and higher lows. And we're on the way up right now. So S&P 500 is doing well. And everybody's like, yo, with the economy slowing down, why are they doing so well? Well, understand that the S&P 500 is weighted by market cap, right? And so it's actually unequally weighted in the sense that the biggest companies have the most impact on the price action of this S&P 500 itself. For example, Apple and Microsoft make up about like 14% of the actual price that the S&P 500 shows, right? So if Microsoft and Apple are doing well, then the S&P 500 is going to do well, even though the rest of the freaking 498 stocks might not be doing so hot. But if the two front runners are doing well, then it's going to carry it. And it's not even really just the two. So the S&P 500.
Amazon too. Amazon, Nvidia, you have Google in there, you have Meta, you have United Healthcare, Exxon. All these companies are at the top of their industry.
Yeah, literally 10 companies account for 30% of the index. Just 10 companies account for 30% of that 500, right? So that's why you see this going up, because those top 10 big tech companies are driving the whole S&P 500. But when you look at the equal weighted index, which means there is no one stock in the 500 that impacts the other, look what comes up right here. You see this chart is a little bit different. If you see since February, the equal weighted index is actually going down. It made a low and it makes a lower high, and it may make a lower low. We'll see, but it just looks a lot different than the S&P. You see it's upwards to the right, and this chart right here is showing a lot more weakness. All right.
Can you just explain this again one more time? So this, just to make sure, this is a chart. Let me see if I can actually say it right. So is this a chart where you're basically showing an index of every company has the same percentage in the top 500?
Yep. Because you know how we say Apple and Microsoft they're so heavily weighted that if they're doing well, the whole S&P is doing well. Well, nah, for this one, everybody's the same weighting. All 500 companies have the same weighting. And so it's something interesting to see. And we've been talking about smaller businesses, so it'll make sense for us to now look at the IWM, right? What is this? This is the Russell 2000, which is the 2000 small cap companies. So small cap, these are the smaller businesses. Yo, guys, do y'all notice right here? Let's really look at this. Down here, this lowest price is the October lows, which in other words was the bottom of the bear market so far. Look where we are. We're right near October lows. The most recent price action is all the way to the right? We are right near October lows, y'all. So it shows that smaller businesses are not doing well. I know the S&P 500 is rallying. Microsoft, Apple, Nvidia, everybody's doing great. It's really just focused on the big tech is carrying the rally. And we talk about the S&P 500, but the NASDAQ is similar to where was it? The NASDAQ basically is the same thing, where they're being front ran by the biggest companies. Mm-hmm. So, guys, don't be fooled. If big tech comes down, everything's coming down, because other things have already gone back to their October lows. It's just big tech is fueling the rally.
I mean, there's no difference, right? Like when you look at QQQ, which is a resemblance of NASDAQ, right? So when you look at it, 12% is Microsoft and another 12% is Apple. So it's like they actually have a bigger holding in the Apple and Microsoft than the S&P 500. And then you have Amazon, which is 6%, and then Nvidia, which is 5%. So these companies are even held up way higher. So the top 10 holdings of the QQQ actually make up 55% of the entire index itself. So
that's crazy.
Just to give you guys a perspective of it. So at the end of the day, it's not, and this is, I guess, I don't want to make this episode too long for y'all because it's supposed to be a summary part, but just to kind of put this in there, just think about it. How are these companies doing so damn well when the interest rates are this high? Like, are they not borrowing? Do they have enough cash on hand? Yeah, I understand you're doing layoffs and everything of that sort, but I don't know. I'm a little wary still. I'm not dumping everything in there, but I just basically think very out loud when it comes to this stuff.
I mean, we've seen the cloud services for Google and Microsoft are still doing well. So it shows that even the cloud is up. I don't know, bro. So software is still being bought. Like, bro, I don't know what to say, man. These companies are still performing, and it's really just big tech. And as we see in the Russell, it's really just big tech, because other businesses around the country are not really doing so well.
And it makes sense, bro. We're in a time period where it's hard to borrow money. How are you doing well if you can't even, invest in your own business?
And that's why people are just dumping money into big tech as a safe haven, even more than regional banks. Regional banks are going under. So big tech has more cash on hand than these regional banks do at this point. Mm-hmm. And so it's literally like a better safe haven at this. So it's kind of an interesting time period. Last thing I would say here is that people in this time period see the economic slowdown coming because the Fed is so vocal. This is the first time when the Fed is doing these big TV announcements on what they're going to be doing. It wasn't like this in the past. So this is the most predictable recession ever. And so that may be why the market is rallying so much, because everything that's happening has already been predicted and prepared for. And so DCA. DCA.
Yeah, at the end of the day, honestly, that's kind of the best approach. And I know you guys might sound like, oh, we're saying the same thing over and over again. The information is changing, but the actual conceptual thing that you should be doing stays the same. And I don't think it's ever going to change. But that's really the summary of this episode. We wanted you guys to know what's happening this week. We wanted you guys to know, be aware. We're going to give another episode on Wednesday where we're going to break down what the actual news is, right? So there's going to be a lot of information out here. But if you're still watching, thank you. We appreciate you. Please make sure you like, comment, and subscribe to the channel. Let us know if you want to sponsor us. But hit that little notification bell because we drop
2 videos a week.
And you don't want to miss them. Check us out on Wednesday. But until then, peace.
Peace.
Soundstripe.